We are looking at the start of the Q2 earnings season next week. Banks like Goldman Sachs and JP Morgan report first, followed by TSMC. With market valuations sitting at historical highs, this earnings cycle is going to be the ultimate stress test for stock prices. Let's look at the numbers. Goldman Sachs is scheduled to report on July 14th. Analysts are projecting earnings per share of $14.34. That is a 31% jump year over year on $16.12 billion in revenue. A key area to watch will be their investment banking deal flow, including their role as the lead underwriter for the highly anticipated SpaceX IPO, which should give us a clear look at corporate deal-making activity. 2 days later, on July 16th, Taiwan Semiconductor reports. Estimates are pegged at $3.81 per ADR, an impressive 46% surge in earnings, with revenues expected to grow 26% to nearly $40 billion. These numbers show just how much hardware demand is backing the tech sector. And the demand isn't slowing down. TSMC's next-generation 2-nanometer production, what they call N2, is already booked out by Apple and Google. That tells you that the biggest tech players are locking in their hardware supply lines for the next several years, well ahead of production. But on the technical side, the market is facing some immediate hurdles. The S&P 500 has support down at 739, and the Nasdaq needs to hold 715. We are also seeing a massive options put wall at 700 that could trigger negative gamma selling if we break lower. It means the margin for error here is very thin. We're already seeing this pressure play out. The Philadelphia Semiconductor Index, or the SOX, is undergoing a major technical support test at 550. If the index fails to hold here, it could signal a deeper pullback for tech stocks. In fact, the AI trade is facing its first real stress test in a month. AI-adjacent and infrastructure stocks are down 6 to 10% over the last few weeks. Investors are starting to ask if the massive capital spending is translating into real business profits. Interestingly, Nvidia itself is trading at a discount. At 22 times forward earnings, it sits well below the semiconductor average of 36 to 37 times. It shows that even though Nvidia is the face of the rally, its actual valuation is much more conservative than the hardware makers surrounding it. But the real disruption in AI might not be in hardware. Bridgewater's latest research suggests that companies are building free, open-weight models trained on their own data that outperform frontier lab models. The kicker? They're doing it at just 5% of the cost. That is a massive threat to the margins of major AI developers. We're already seeing the effects of this cost focus. OpenRouter data shows that nearly half of the token volume from U.S. companies is migrating to Chinese models, which are proving to be much more cost-efficient. In fact, China's new GLM 5.2 model is reportedly performing at parity with top U.S. models like GPT 5.5 in reasoning and coding benchmarks. To combat these rising compute costs, the major players are building their own silicon. Meta's proprietary AI chip is scheduled to enter production in September. By bypassing generic compute, Meta wants to optimize its margins and rely less on external hardware providers. Underneath all this, the macro picture is raising some flags. The cyclically adjusted PE ratio, or CAPE, is sitting at 40, which is double its historical average. At the same time, U.S. national debt is on track to hit $40 trillion this year, with interest costs projected to reach $1.6 trillion. That means interest payments are now one of the government's largest expenses. Faced with these high valuations and macro debt pressures, capital is starting to look for safety in cash flow. Verizon stands out here, forecasting $21.5 billion in free cash flow this year. With a payout ratio of 57%, significantly lower and safer than peers like Pfizer or Pepsi, it represents the kind of defensive, cash-backed quality that investors are starting to prioritize.